Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of Financial Management Revision Series, and we are moving on to our next chapter, another very interesting chapter, that is dividend decisions. A very easy, very small chapter. I don't think we are going to take more than 10-15 minutes for this chapter, right? So dividend decisions is very interesting. Now, what is this chapter all about? This chapter says that, let's say if you are earning an EPS, that is earnings per share of 100 rupees, out of this 100 rupees, how much you want to retain in the business and how much you should be distributing as dividend among the shareholders, right? So this chapter is all about this, right? If you are earning a EPS, how much should be retained and how much the dividend should be distributed. So the decisions regarding what proportion of the earnings to be paid to the equity shareholders and what should be retained in the business for the long term growth, that is what is the main purpose of this chapter of dividend decisions, right? Now, impact of dividend on the market price of the share, right? Sir, some of the theories were of the viewpoint that yes, the dividends impact the market price, but there was a theory that was given by that is Modi, Giuliani, Miller. They say that the dividend does not impact the market price of the share, right? Why? We'll discuss later on. Now, if it is a growth firm means the firm which has the growth opportunities in the coming future. Then what should that firm do, sir? Whether that firm should distribute more of dividends or whether that should retain some money from the earnings, whether they should try to retain the money and use that money for the growth opportunities. Obviously, sir, the dividend payout ratio should be low. That means more money should be retained in the business, right? And if they are going to follow the high dividend payout ratio, then the market price will obviously be low, right? Because the market price is determined by the perception of the people, and the people will perceive that though the firm is having the growth opportunities, but still the firm is distributing more amount as dividends. They should have retained that money and they should have used that retained money for the growth opportunities, right? Now, if it is a declining firm, if there are no growth opportunities, sir, in that case, you should distribute the dividend. The dividend payout ratio should be high. In case the firm is not distributing high dividend, in case of low dividend payout ratio, the market price will be low, right? In case of a constant firm, no impact of dividend on the market price of the share, sir, right? So there were the two important terms now regarding this. One is KE. KE is the cost of equity or the expectation of dividend by the equity shareholders, right? Or the cost for the company. What is the rate of dividend that the equity shareholders are expecting from the company? Another term is R. R represents, we have discussed this in the cost of capital also when we were discussing about cost of equity, that, sir, R is the rate of return on the retained earnings, right? If you are going to retain something, you will invest that money, and by investing that money, what is the return that you will be earning from there? The rate of return earned by reinvesting the retained earnings, it is a capital appreciation for the equity shareholders, right? It is a capital appreciation for equity shareholders. So there were various models. The one is the Walters model, right? In every model, okay, listen, before we move on to the models, one very important thing, sir, related to the R and KE. What is there? Now, if I say this R is greater than KE, what should be done, sir? If you retain the money, the rate of return on that reinvestment of the retained earnings, that is higher than the dividends that you might be getting straight away, what should be done? What should be done, sir? If R is greater than KE, dividend payout ratio should be low. Dividend payout should be as low as possible, right? Why, sir? Sir, if you will retain money, you will reinvest that money, and whatever the return that you will get from reinvestment, that is higher than what is actually the dividends that you will get now. If now you are getting the 10% dividends, it is quite a possibility that if you retain the money, you reinvest that money, you earn at the rate of 15%. So why not retain and reinvest, right? So dividend payout ratio should be as low as possible. If R is less than KE, then dividend payout ratio should be high. Dividend payout ratio should be high. Right, sir? If R is equal to KE, then we are indifferent. Then we are indifferent whether to pay dividends or whether, to go for whether to pay the dividends or whether you retain the money. We are indifferent about that. Clear? So this is a very important relationship, and this is used while doing the questions, sir. This is used while doing the questions, right? Very important. If R is greater than KE, then dividend payout ratio, then dividend should be as low as possible. Even you can distribute zero dividends. Everything should be retained and reinvested, right? Okay, so the first model that we have is Walter's model. The dividend payout affects the market price of the share. According to the Walter, what is the dividend that you are paying that will affect the market price of the share, right? How? He says how you can determine the price of the share. The price of the share is dependent upon what is the dividend that you are distributing plus what is the return that you are getting on your retained. E minus D is what? E minus D represents your retained earnings, right? So he says the current market price of the share is dependent upon two things. One, what is the dividend that you are going to pay? Secondly, what is the return that you will be earning on the retained earnings, right? So E minus D represents your retained earnings, R represents the return that you will be getting, divided by KE represents the present value. So listen to it very carefully how this formula is derived. Okay. What is the logic behind it? Why we are dividing it? First we are dividing R by KE, then whole by KE. Why we are doing it like this? Listen to it very carefully. For example, let's say this is the zero period. You want to find out the price here. That what is the price? I say the price is dependent upon what is the dividend that you are going to pay in the future plus the return on retained earnings. Now what happens? After 1 year, this is the first year. Here you have, let's say, the earnings of 100 rupees. Now, out of this 100 rupees, what you have decided? You have decided to give the dividend of 60 rupees and you have decided to retain 40 rupees. Fine, sir. Right? Now, if you want to calculate the price at the present period, so what you will do is, you will calculate the present value of this D1, right? That is what? This is, I say, you will calculate what the present value of D1, that is represented by D divided by KE. This is the first part of the formula, this one, right? The present value of the dividend. Fine, sir. Now what happens with the retention? Now here at first period, you have retained 40 rupees and you have reinvested. Let's say you have reinvested this money for another year. Right, here you are getting, this is reinvestment at the rate of, let's say, 10%. Here you will earn how much, sir? You will earn 4 rupees, right? This is what? This is the rate of return on E minus D. This is 10% on what is the earnings? 100 minus what is the dividend paid? 60, right? So this is R into E minus D. Now why divided by K? Sir, to calculate the impact of this on the price, what I will do is, I will first bring this value here. I will first bring this value here. To bring this value here, what is done is R E minus D divided by KE. Right? This represents this value. Now, from here, I want to find out the price, current market price. From here, I want to bring this value here. So what I will do for here is, I will do R E minus D divided by KE, whole divided by KE, right? So that is why this formula has been framed, sir, right? So this is the Walter's model. E represents EPS, D represents what is the dividend that you have paid, R is the rate of return on the retained earnings, right? And K is the cost of capital or the expectation of the equity shareholders. Right, so this is the Walter's model, and this logic remains the same in the Walter's model also. If R is greater than KE, then the dividend should be as low as possible. If R is less than KE, then dividend should be high. If R is equal to KE, then you are indifferent whether you pay the dividends or whether you retain the money out of your earnings. Right, so what is there? depends upon the R and KE. The second is the Gordon's model. The Gordon's model also say that the dividend payout affects the market price of the share. It also affects the market price of the share. Now, how this formula has been generated, the dividend, this is also known as dividend growth model. This is also known as Gordon's growth model, right? Or we also call it as dividend growth model. Now, how this formula has been achieved? When we discussed about the cost of equity, there we say that KE is equal to D0 into 1 plus G, that is D1 divided by P naught plus G. Now, here we want to find out the price, right? Because we want to find out what is the impact of dividend on the price. So what I will do is I'll take G here, I'll write KE minus G is equal to D0 into 1 plus G divided by P naught, right? I want to find P naught, I'll take it here, I'll take KE minus G here. So P0 is equal to D0 into 1 plus G divided by KE minus G, right? So this is how the value of the share has been calculated, right? So this is as per the Gordon's model, and again the logic of R and KE remains same, sir. If R is greater than KE, the dividend should be as low as possible. If R is less than KE, then dividend should be as high as possible. You can give 100% as dividend and retain nothing. Clear? After that, traditional model, just remember it, not at all important. Price is M is what? A multiplier. D plus E by 3. He says the more weightage is given to the dividend than the earnings. We have to take 1/3 of the earnings only, right? Just remember it, not at all important. Linter's model, again not at all important, just remember it that in the case of Linter's model, you have to calculate what is the dividend you are paying at the end of the year. This is the dividend at the end of the year. What is the expected dividend? That is dependent upon D0, what is the dividend that you have paid, plus EPS into target payout, right? Out of the EPS that you will earn in during this particular period, right? What is let's say you want to pay 60%, this is your target payout, right? Minus what you paid in the last period multiplied by the adjustment factor, right? Multiplied by the adjustment factor, it will be given in the question, right? Adjustment factor represents that what is the variation, how the dividend will adjust according to the market price or according to the inflation, right? So that is Linter's model. Simple. Now, another important hypothesis, I'll not go into the derivation of it, right? But what is regarding the hypothesis, the approach says, that is Modi-Giuliani-Miller approach says that the dividend does not affect the market price of the share. According to Walter, according to Gordon, that market price of the share is dependent upon the dividend. It is impacted by the dividend. The theory says, Modi-Giuliani-Miller says, whether you pay dividend or whether you do not pay dividend hardly matters. The market price of the share is unaffected by it, right? So this is the formula that was given by them, that is NP0. What is N here? N represents the number of existing shares. What is the existing number of shares you have? P represents the price at 0 period, right? So this represents the total value of shares, total value of shares at 0 period, sir. Total value of shares at 0 period, right? Then he says how to calculate the value of shares at the 0 period. He says it is unaffected by dividend. How? This is the formula that is given. I am not going into the derivation. Derivation is not anyhow not going to be asked in the examination, right? But what you should remember is N. N is the number of existing shares, old or existing shares. What is delta N? Delta N represents the number of new shares to be issued multiplied by P1. This whole thing represents total value of shares, total value of shares at end of period, at end of period 1. That means, what does it mean, sir? Listen to it carefully. What does it mean? Let's say this is 0 period and this is the first period. You have some shares here. NP0 represents what is the value of shares at 0 period, right? And now at the end of the first period, you will have the existing number of shares plus you want to issue some new shares also, right? Plus delta n divided by P1. P1 represents the price at the end of the period, right? So this is what? This is the total value of shares at the end of period 1 minus in I means the fresh investment that you want to make, for which you are issuing new shares, right? I represents what? The investment to be made, and Y represents the total earnings of the equity shareholders, the present value of all this. Here you want to make investment, here you want to make investment, here you want to make here you will be having the earnings also, right? So the present value of all this will will represent NP0. Is there dividend anywhere? Anywhere do you see the dividend here being used? No, sir. That is why he says the dividend does not affect the market price as per hypothesis, right? Now, in this case, one calculation, sir. How to calculate what is the number of shares you want to issue? What is the number of shares you want to issue? Listen to it very carefully. Let's say your total investment that you want to make, is 10 lakh rupees. Now, what is your total earnings? Your total earnings is, let's say, 5 lakh rupees, right? It is 5 lakh rupees. Now, what you can do with the earnings? If you are going to pay dividend, let's say the question says out of this earnings, you will pay a dividend of 3 lakh rupees, right? This is what you will pay as dividend, and 2 lakh you will retain in the business. 2 lakh you will retain in the business, right? Now, how much of the new shares will you require to issue? Sir, what is the total investment that you want to make? What is the total investment that you want to make? 10 lakh rupees. Now, for this 10 lakh, is there any retained earnings available? Yes, sir. The retained earnings is available to the tune of how much? 2 lakh rupees, sir. Right? So that means equity shares worth 8 lakh rupees you will have to issue. Now, when you are issuing, how to calculate the number of equity shares, sir? How to calculate the number of equity shares that you will be issuing? That is 8 lakh divided by what? Sir, divided by P1. P1 means you are going to issue the shares here, sir. One second. You are going to issue the shares here at the end of the first period. So the price that you will take is at the end of the first period, sir. Right? So 8 lakh divided by P1. Now let's take another scenario. In the another scenario, he says you are not paying any dividend. Everything, the 5 lakh you are earning and the 5 lakh you are going to retain in the business. So this was first scenario. What will happen in the second scenario, sir? In the second scenario, what is your investment? Your investment is 10 lakh rupees. Out of that, what is the amount of retained earnings that you have? You have 5 lakh rupees with you, sir. You have 5 lakh rupees with you, right? So what is the amount of shares to be issued? Now you want to issue the shares worth 5 lakh rupees only, right? So if you want to calculate the number of new shares, that is delta n, how will you calculate it, sir? That will be 5 lakh divided by what? That will be 5 lakh divided by P1. Clear, sir? Divided by P1. Sir, how the P1 will be calculated? How the P1 will be calculated? Sir, for that, if you want to calculate P1, there is a formula that is there, that is P0, that the present price is dependent upon dividend plus P1 divided by 1 plus KE. Right? If you want to calculate the P1 from here, this P0 will be given to you, D1 is there, KE is given to you, you can calculate P1 from here, sir. P1 will be P0 into 1 plus KE divided by, not divided by minus D. Right? Minus D1. So this is how the P1 can be calculated, sir. Some of the information will be available in the question itself, right? So this hypothesis questions are very, very important. Please do all these questions from the module, right? I have given you the basic information, the basic outline that what hypothesis wants to say regarding the dividend and the relationship of the dividend with the market price of the share. So Modi Giuliani Miller says that the dividend does not affect the market price of the share, right? That is why they have given this. There is a whole derivation, right? In the regular lectures I have done the derivation. The whole derivation I have explained, that how this formula has been framed, and some part of that derivation I have already explained here, sir. Clear? So this is regarding the dividend decisions, the end, sir. Right? That's why I told you that we are not going to take much time. Now, the last chapter that you will do it on your own, because that is a very easy chapter, that is risk analysis in capital budgeting. Right? That is risk analysis in capital budgeting. Just go through it. All those who are having these capsule editions, they can go through with the capsule editions. That is a very, very easy chapter. Right? What is this risk analysis in capital budgeting? It says that in the capital budgeting, we are trying to predict the future cash flows, and there is always an element of uncertainty related to the future cash flows. If I say in the future I will have a cash inflow of 4 lakh rupees, right, whether that is going to happen or not, that is a probability, right? Because there is always a risk element when we are talking about the future. We can't be certain about it. That is why this chapter was there, risk analysis in capital budgeting, and this was introduced in this course. It has again been removed from the new course, right? So just go about with the risk analysis once, that every capital budgeting has an element of risk involved in it, because the future cash flows cannot be predicted with precision. So this risk element must be adjusted in every capital budgeting decision. So there are various techniques related to it, like the probability, that if you are having a cash, there are various events and you are having the cash flows, their probability, what is the expected cash flow, what is the basically what is the average, on an average, what is the expectation based on the probability that we are going to have that cash flow, right? The expected net present value can be calculated, that is the present value of this, right? Present value of this expected cash flows minus the present value of cash outflows, right? After that, variance means the difference between the actual cash flows and the expected cash flows. The difference between the actual cash flows and the expected cash flows, square root of that, multiplied by the probability of an event. What is the probability that there will be this much of a variation, right? Standard deviation is under root of variance. Then coefficient of variation is standard deviation by expected cash flows, right? Risk adjusted discount rate, that means there can be a risk free rate plus the risk premium. If you want to invest in a risky investment, then you will require something extra, you will ask for a greater return, right? In this question, calculate the NPV at risk free rate and the risk adjusted discount rate, and this question has been asked, sir. This question has been asked in the examinations. I think once or twice in the RTPs also this question was there, right? Then certainty equivalent method, that what is your expected cash flow, and out of that expected cash flow, what is the certainty, what is the amount that you are expecting that you will certainly get it, right? That is known as certainty equivalent coefficient. Just go through with the questions, very easy chapter. Then there is one sensitivity analysis and scenario analysis, right? Sensitivity analysis and scenario analysis, right? What is sensitivity analysis? I'll just quickly go through with it. What is sensitivity analysis? Sensitivity analysis says you are calculating the NPV based on certain elements, right? You are calculating the NPV based on certain elements. It can be the discounting rate, it is based on cash outflows, it is based on cash outflows, it is based on cash inflows, it is based on your discounting rate. Now he says you calculate the NPV based on this. Now he says if your cash flows change, what will be the impact of that change on the NPV? On the NPV, what will be the impact of the change? What is the sensitivity of the NPV in relation to cash outflows? Then if you change your cash inflows, then how your NPV will change? What is the sensitivity of the NPV in relation to your cash inflows, right? So this is regarding the sensitivity analysis. And the scenario analysis says under the worst case scenario, under the best case scenario, and under the normal scenario, what is going to be the NPV, how the various factors are going to behave, right? Just do the this module questions on risk analysis and capital budgeting, more than sufficient, right? So with this, what we have done is we are done with the revision of financial management. All the chapters we have done, right? And now it is your turn. You have to practice the questions from the module. And that's it, sir. That was my responsibility for CA Inter November 2023. It's now your turn, your responsibility to practice more and more questions. And thank you to all the students who have given their support, although not the kind of support that we were expecting, but still, thank you to all those who have supported, who have been watching these lectures, right? And thank you so much, guys, and all the best for your preparation. We'll see you guys soon with more videos. So subscribe to the channel and press the bell icon so that you do not miss out anything in the future also. See you guys. All the best for your exam preparation of financial management and economics for finance. I really hope that you people are doing up with that subject, right? See you guys. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.